Gold just ripped 52-week highs. Silver is breaking out with momentum. Platinum and palladium are lining up for big moves. These aren't small shifts. This could be the start of a major breakout in precious metals. The key now is how to position. Where are the setups, how to assess the risks, and the trades worth watching. Let's dive in. All right, so we have this gold breakout to 52-week new highs. In fact, all-time new highs. So yesterday's breakout was a legitimate start to a new bull run. So let's put this in context. We started the year with a beautiful 4-month bull advance that saw the gold market rally, in this case, almost $1,000, 925 to be exact, but a 35% run before beginning what is this sideways horizontal triangle formation consolidation that has basically been the story for the last 4 months, the sideways trade range. So when you have a consolidation of this length and magnitude, it has unwound all of the overbought state of gold. And so we now have a legit new start of a bull leg. And using the rules of symmetry, if the last bull run was about 900 some odd dollars, there's no reason why this current bull run can't be of similar duration. And so if we just use the May low as the starting point, a measured move takes us over $4,000 an ounce on the upside. So there is plenty of upside still here on gold on this breakout. And I think all of our listeners should be taking advantage of this bull run. But let's look a little deeper by looking at where we are on a lot of the other markets. Now, let's start off with silver. Silver also broke out to a fresh new 52-week high. At this stage, if you go and look at where on a weekly chart basis, the major high from 2010 and 2011 were these major highs near $50, $48 to $50 on the upside. With this breakout, there's no reason why silver can't continue to target those major all-time highs. And so this silver breakout is pretty legit. Now, obviously, I like to buy dips, not rips. So I want to buy short-term pullbacks. But this also is a very legit breakout. Now, what else is interesting, the precious metals, is that platinum is trying to join the party. Now, platinum had an extraordinary bull advance from April through July and has spent the last 2 months more or less backfilling and consolidating, with the 50-day moving average having literally contained all of its selling. With the recent breakout in the last couple of days, it has really put platinum back in play for another bull advance. So we're watching to see whether this next platinum move can really get underway. Maybe we could see 1,600, even 1,800 on the upside. And then you take palladium. What a beautiful retracement. This was essentially a 61.8 retracement, temporarily closing below its 50-day moving average and just turning up, closing back above the 50-day for a potential new bull advance. Will we see palladium join this party and head up to $1,400-$1,500? These are all in play. So the big question that all of you may be wondering is, how do you play this? Now, first of all, the natural instinct for many retail investors is to turn to gold miners. There's only one problem with that. The gold miners have been one of the hottest markets for all of August, basically running close to $12 or 25%, but long before gold's breakout. The thing here is that gold miners at this stage are nowhere near as asymmetric as gold. And this is the tricky part of expressing this trade by chasing these gold miners. Now, look, if you're pure momentum, then you can accept no substitute for continuing to plug into these. But to me, I feel trading the precious metal here has much more asymmetry through the bullion than it is in chasing the gold miners themselves. Now, That doesn't mean, by the way, that the gold miners can't do better, but the way I kind of put it in this perspective, if gold miners here threw back 10%, going from $65 back to $59, and let's say a move like this, could you say that in any way that the bull trend is over? Absolutely not. And that's the point, is that where would you put stop losses? How do you manage the risk on a trade like the GDX by buying at this stage? And so to me, it's much easier to put on the trade in gold. So the way that I'm playing this is through the GLD, the gold bullion ETF, and to me, this is a very easy way to put on the trade. Now, some of you with smaller amounts of capital can play the beautiful option skew on on gold by opening bull call spreads. But I want to demonstrate a trade here that is focusing on putting on this trade simply in an asymmetric way, demonstrating risk management and still giving an opportunity for a great return. So let's have a look. All right, here. So I've got the GLD here up on an Interactive Brokers account, and I want to show you right here that it's trading up $1.71 here in the pre-market at 327. So I want to approach this from a perspective of coloring in buying the shares. And so here, if you're bullish on this and you want to buy it, you just come in here outright and buy any quantity of shares that you are appropriate for your sizing in your portfolio. Now, to me, what are the interesting way to risk manage this trade is to put on a collar. And so what I want to show you here is that, to me, this is incredibly asymmetric to putting on a collar to manage the risk and allowing you the stability to hold this trade without being shaken out if there is some short-term volatility, if, let's say, there's a short-term market event driven by jobs numbers or the Fed rate cut or some other type of an event. So what I want to talk to you all about is the idea of collaring this trade. This involves the buying of a put option and selling a covered call above to basically collar, create a maximum downside risk and a maximum upside potential. Now, I specifically wanted to leave the upside on the GLD up to the $360 level. That really does equate to somewhere very close to $4,000 on gold bullion. And so we want to make sure we can capture the upside move of a gold run up towards 4,000. You can see here that this $360 strike covered call is right now paying just over $1. This is pre-market, but it collects you about $1 per share in income. That gives you a solid 10% upside potential on this GLD. At the same time, in October, $310 strike put insurance is costs about $2. So you collect $1 income, but pay $2 out for the insurance. It net costs you $1 per share to put this collar on. But here's the key: the hedge kicks in 5% or $15 below the market. So you have a 10% upside and a 5% downside risk, creating a payoff profile that's 2 to 1. And all of this comes at just a cost of $1 for the next almost 2 months. And so this is a great way to put on the gold trade where you simply own the shares like a traditional investor, but yet don't have to worry about using stop losses or worrying about that you might be caught in a fake out breakout, because this really does set you up to have an exit strategy if this isn't going to stick, and yet give you all of the upside potential to capture this kind of a bull impulse. All right, so let's recap. Precious metals really starting to move. There's lots of opportunity. I'm not so excited about the gold miners here as a new trade, but even if you did want to put on the gold miners, probably a traditional bull call spread is the best way to construct asymmetry into a position that has already run up so much. But really, our favorite way to put this on right now is simply to collar in a GLD position. If you're interested in looking into this trade a little bit deeper, In the description below is a PDF link where you can take a look at the breakdown of this trade and what it looks like. It's September. The markets have woken up. There's going to be lots of these trades. I'm looking forward to talking about many of them with you on this channel. So stay tuned. Thanks, everyone.